I think it's very important not to conflate the avoiding of an escalation with a deal, because while, of course, this is a short-term positive from a market's perspective, the uncertainty that existed going into this still exists. And many of the knottier, bigger, intractable issues that led to the breakdown of talks in May were not addressed in this summit in Japan. So, we think that, again, short-term positive, but from an uncertainty perspective, from a confidence perspective, this will continue to be we think a headwind both from a market's perspective and then potentially from an economic perspective as well.
Jason, we're certainly light on all of the details here. It almost feels like over the past year, the expectations have been reworked for the market in terms of trade between the U.S. and China, where the Dow is now rallying triple digits just because more additional tariffs on more additional goods aren't being put in place. How do you think about it?
So I think in this case, not having bad news is good news. Just taking away maybe some of the tail risk on the downside is a positive. We don't know, obviously, the details of what's going to happen. We don't have a clear idea of how the negotiations are going to take place. But I think as an investor, you kind of calculate what's in the incentive on both sides for whether it's President Trump or President Xi. At least on President Trump's side, the longer this kind of goes on before there's a deal or this kind of negotiation takes place, the incentive to increase the tariffs actually declines. Because then you worry about the risk of having a real slowdown in the economy going into next year and even well into next year prior to the next election. So the window for them to actually increase tariffs without having an adverse effect on the economy there for the markets is pretty small. So even though we don't have clear plans, I think by just taking away the tail risk, that's the market's responding to that, because I think this feels like you're on a path towards at least no sustained escalation.
Libby, this process of trying to handicap the game theory of it all and how the incentives line up and how we're going to read the minds of people leading into an election. You've heard plausible cases made this morning that this is great because the president can kind of keep this as an ongoing process and run on tough on China and all the rest. At the same time, people say, wow, he needs a deal by the end of this summer if he wants to release the economy into a new growth phase going. So is there a productive way to think about this?
Yeah, I think, I think a few things. One is that while I think the market is hopeful that we're avoiding an escalation, I would just, be a little bit skeptical of that thinking, only because, a year ago, sort of referring to what Morgan was saying, is that I don't think people thought that we would have tariffs on $250 billion of Chinese imports. I mean, this president, and we might disagree or we might agree, really fundamentally believes that tariffs actually work. He thinks that he got a better deal on NAFTA 2.0. He thinks that he's gotten China to the negotiating table. So I wouldn't necessarily discount the risk of escalation here. With that said, does he need some sort of resolution going into 2020? Maybe. But is China a convenient boogeyman going into 2020 as well? Yes. So I think that the kind of bottom line here is absolutely hard to handicap. But you also look at what the president has done previously. And again, he thinks tariffs work. So I don't think that we can say that this tail risk is off the table. And I think that, over the weekend, again, nothing was really clarified. Yes, there was a temporary truce, but we certainly didn't see a settlement.